Yo, what's going on, everybody? Today I'm going to be talking about how cryptocurrency tax is treated because, everyone's starting to get really more into cryptocurrency lately due to the pandemic. It's getting a lot of popularity. Everyone's becoming day traders, all that stuff. So there's a lot of unanswered questions that I have from people that they're wondering how cryptocurrency is taxed. And, I understand because the tax reporting on cryptocurrency is not really that great at the moment. I mean, it's better than it used to be, but still not that great. So I'm gonna just go through the basics, basically the 101s of how it's treated. So contrary to what you might think, cryptocurrency, because it is a currency, is not actually treated as like gains from foreign exchange currency. The IRS has decided to treat them more like stocks. Which is interesting. So what does that mean? That means that when you buy a cryptocurrency, you buy a coin, you don't get taxed. And then, when you sell it, if you sell it within 1 year, then you're taxed at short-term capital gains. And if you sell it after a year, or if you hold on to it for longer than a year and then sell it, then you're taxed at long-term capital gains. Now, long-term capital gain tax rates are more favorable. Most people will pay 15% on long-term capital gains. If your total income is less than $40,000, then you actually pay 0% long-term capital gains. And if your total income is greater than about $440,000, then you pay 20% capital gains. And now those income numbers are per person. So if you're married, then your joint income has to be below $80,000 to pay 0%. And obviously, whatever the top tax rate for married filing jointly is, that's the 20% capital gains rate. So I'm gonna go through some various scenarios and then some various examples of how these cryptocurrencies are treated in terms of taxes. So what happens if you just buy a coin? Let's say you buy like one Bitcoin because you have $40,000 to spend on Bitcoin. Let's say you buy one Bitcoin and then you do nothing. What happens there? So if you just buy and hold, then there's no taxable events. But one thing to remember that's important is the price that you paid for the coin when you bought it is called your basis. And that's important for later when you sell it, okay? So you buy a Bitcoin for $40,000, your basis in that Bitcoin is $40,000. Now when you sell a crypto, that's when you actually realize the gain. Okay, that actually becomes the taxable event is when you sell it. So you buy it, nothing happens. When you sell it, that becomes a taxable event. And that includes swapping or trading coins, whatever you want to call it. If you swap, that's a taxable event, okay? Because you're technically selling one coin and then purchasing another immediately. So be aware that if that's what you're doing, you're creating taxable events as you swap coins. Obviously, if you sell or swap the coin at a higher value than you purchased it for, that would create a gain. And if you sold or swapped a coin for lower than you purchased for, that would create a loss. And these capital losses are treated, differently than what you might think. Capital losses have to offset capital gains. So that means if you have $40,000 of capital losses, you can't really take that against your ordinary income, your ordinary W-2 income, okay? You can only take $3,000 per year of capital losses against your ordinary income. And the rest gets carried forward year after year until it's used up. So if you have $40,000 of losses, but let's say you have $100,000 of gain, then they can offset each other. Then you technically have $60,000 of gain net. All right, now I'm going to run through some examples of how actual coins being purchased and sold will be treated in terms of taxes. So my first example, let's say you buy some ETH. You buy it for $2,000, and so your basis is $2,000, and then you hold on to it for 2 years. After 2 years, it's worth $4,000, and that's when you decide to sell it. So now you have a capital gain of $2,000. That's the 4,000 minus 2,000. Capital gain of $2,000. You held it for longer than a year. So you're gonna be taxed at the capital gains rate, which is 15%. So your tax on that transaction is $300. Pretty simple, pretty straightforward. Okay, so now my second example involves like a more recently popular meme coin, shit coin, whatever you want to call it, Shiba Inu. Now let's say you bought $1,000 worth of Shiba Inu when it was worth $0.000002, and then 3 days later you sold it and it was worth, and your $1,000 had grown to $14,000. That's a $13,000 gain in 3 days that you held it for. So now you would treat it as a short-term capital gain, which is taxed at your ordinary income tax rate. Now there's no specific number I can give you for your ordinary income tax rate because it all depends on your income. The US has a progressive tax rate scale, so the more money you make, the higher your tax rate gets as your income increases. So whatever your ordinary tax rate is, that's what this $13,000 gain will be taxed at. All right, the third scenario I'm gonna run through is a swap. So I'm gonna just combine my first two scenarios and turn it into a swap. So let's say you buy $2,000 worth of ETH. Okay, one ETH for $2,000. 2 years later, you decide to swap that ETH for some Shiba Inu. And that 2 years later, that ETH is worth $4,000. So you swap it for $4,000 worth of Shiba Inu. And then 3 days after that, your Shiba Inu is worth $56,000, so you decide to just sell it. So what happens there? What's all the components happening there? So first is you bought ETH for $2,000. Remember, that's not a taxable event, so you bought it for $2,000. 2 years later, you swapped it for Shiba Inu. Now when you swap, you technically are selling ETH and buying Shiba Inu. So 2 years later, you sold ETH for $4,000. That means there's a long-term capital gains for $2,000 there. Taxed at 15%, that's $300 worth of taxes. So now you have $4,000 worth of Shiba Inu. 3 days later, you sold it because the value increased up to $56,000. So in that case, you have a short-term capital gain because you held Shiba for only 3 days. Now you have a gain of $52,000 that's taxed at the short-term rates. So let's say the swap of ETH and the sale of Shiba happens in the same year. Now you have a long-term capital gain of $2,000 and then a short-term capital gain of $52,000 in the same year. Now, if you have other coins too that have experienced losses, and let's say you sold those coins when they were valued below your purchase price, those losses will help offset the enormous gain that you just realized with Shiba, okay? So hope that's all clear. There's one thing I want to clarify is that just simply selling the coin will realize the gain and means that you would have to pay taxes on it. Some people might think that you don't have to realize any gain until you actually take the cash out of your wallet or out of your coin account and convert it back to USD. That's simply not true. Simply selling the coin will trigger the taxable events. It doesn't matter, if you just put money in your wallet, that's not a taxable event. If you take that same money and just take it out of your wallet, that's not a taxable event. It's the actual trading of the coins that make it taxable. Okay, so the last thing I'm going to talk about is reporting, because from my somewhat limited experience, reporting on cryptocurrencies is pretty limited still in terms of taxes. I know that Coinbase, you can download like your transaction history, but trying to figure out a usable report on your own based on that transaction history, honestly, is a pain in the ass. Because you have to track your original cost basis for all your coins when you sold it, and it gets really complicated if you have different lots. So let's say on June 1st you bought 5 ETH coins for $2,000, and then let's say on June 8th you bought 6 more ETH coins for $3,000. So now you have two sets of ETH coins valued at different values, and then let's say you sell 7 like a year later. So that means you have to track the first lot. You sold 7, so it uses up the first 5 coins you bought plus 2 more from the second lot that you bought. So it starts to get really complicated and starts to get really messy to try to do these reportings on your own. So I did see on Coinbase, they recommended an app called Coin Tracker, which they claim that they will generate taxable reports, tax reports for you if you just upload your transactions to them. And I see that you have to pay for the service, and honestly, it's really worth it because clients pay me $400 an hour if I have to do any kind of like calculations for them. And if I have to do this kind of crap for them, it might take me several hours. It's gonna rack up the bill really quickly. So definitely utilize Coin Tracker after the year ends to make sure you can send your CPA or some usable reports, or if you're doing your taxes yourself, you have some actual usable reports to properly report your gains and losses. All right, so that's all I got for today. Thanks for joining me. And if you found this video helpful, please consider smashing the like button. And then also I'd love it if you consider subscribing to my channel to stay up to date with tax law changes, COVID relief changes, disaster relief stuff, all those things. So see you next time. Take care for now and stay safe. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a